For years, the C-suite playbook had a simple answer for supply chain risk: China plus one, right? Well, our analysis shows that playbook, it's now obsolete. The old arbitrage opportunity is gone, and it's been replaced by a new and frankly unavoidable cost.
We're calling this the efficiency penalty, and it's really the core thesis of our entire analysis. What this means is that diversification is no longer a simple cost-saving move. It's now a very deliberate strategic decision to sacrifice efficiency for resilience. And this penalty, it is absolutely quantifiable right on the balance sheet.
And that really leads us to the central question we'll be digging into. The whole premise of moving production was to de-risk operations. But as we're about to show you, what many firms have actually done is simply swap the familiar risks of China for a new and often more volatile set of liabilities in these so-called plus-one hubs.
Okay, so let's start with Vietnam. It was the first mover, the primary beneficiary of that first wave of diversification. It was seen as the safe haven. But the problem is, it's become a victim of its own success and is now facing saturation on multiple fronts.
This slide really highlights a critical disconnect. The market perception was, here's a straightforward, low-cost, tariff-proof alternative. But the reality, as we see it heading into 2026, is an economy that's straining at its limits. You've got chronic power shortages and, most critically, it's finding itself directly in the crosshairs of U.S. trade enforcement.
And this is the number that should concern any executive with operations in Vietnam: a threatened 46% reciprocal tariff from the United States. For low-margin industries like textiles or basic electronics, a tariff of this size doesn't just erode your profit. It can completely erase it, invalidating the entire business case for relocation in the first place.
And this table really illustrates the convergence of risk. Look at the tariff exposure. Vietnam's advantage is disappearing. When it comes to skilled labor, it suffers from what we call a missing middle, which forces companies to import expensive engineering talent. And customs friction, it's now arguably worse than in China, with crackdowns on transshipment adding more than a week to your clearance times.
So if Vietnam is saturated, the natural next question is about scale. And that brings us to India. It's really the only country that can theoretically offer a volume alternative to China, but its growth is coming with some significant operational friction. This quote from the reporting on Apple's manufacturing shift is absolutely crucial. This isn't just some operational footnote. This is a massive financial liability. A low yield rate is a direct hit to your cost of goods sold, and it's going to impact profitability from day one. And this chart visualizes that financial impact perfectly. A 99% yield rate in China means minimal waste. But a 50% initial yield rate in India, well, that means for every single usable component you produce, you've paid for two. It effectively doubles your raw material cost until that production line matures. That's a huge efficiency penalty.
And to compound that technical problem, you've got a geopolitical one. Beijing has started to weaponize its human capital, preventing the very engineers you need to fix the yield rate problem from even traveling to India. This just proves that even after moving, a company's success in India can still be functionally dependent on cooperation from China.
This brings us to Mexico, the near-shoring play. On paper, it's the most logical choice for the North American market, right? Proximity should be an unbeatable advantage. But that advantage is being seriously undermined by some severe internal risks. This data point is, well, it's telling. 91% of industrial parks are experiencing power failures. For advanced manufacturing, for automotive, for anything requiring precision, stable power isn't a luxury. It's a baseline requirement. This level of grid instability puts a hard ceiling on Mexico's potential as a high-tech hub. And if we want to quantify this risk, the estimated cost of this energy instability is around $200 million per hour for Mexico's entire manufacturing sector. That's the bottom line impact of the grid just failing to keep up with nearshoring demand. And hey, if the power grid doesn't slow you down, the border will. The whole value proposition of nearshoring is speed to market. But when your truck wait times are hitting 8 hours and custom systems are failing, that core advantage is just being systematically eroded by logistical and bureaucratic friction. So, we've looked at the country's specific risks. Now let's aggregate all this and see what it really means for the corporate balance sheet. We need to quantify the total cost of ownership, which, believe me, goes far beyond just labor and logistics. There's a really clear chain reaction here. Longer lead times, which we've seen from both Vietnam and India, force you to carry more inventory. This safety stock isn't free. It's working capital that's just tied up on a ship or in a warehouse, and that directly hits your net margins.
This table pretty much summarizes the entire argument. When you actually factor in the additional working capital for inventory, the overhead of maintaining dual suppliers, the rising cost of compliance audits, and then the emergency air freight you need to bypass port congestion, the financial case gets a lot weaker. The fully loaded total cost of ownership for a +1 strategy can actually exceed the cost of staying in China, even with tariffs.
So, what's the correct strategic response to this new reality? It's not about abandoning diversification, not at all. It's about evolving from that simple +1 model to a more sophisticated and, let's be honest, more realistic operating structure. The new model is what we call strategic bifurcation. It means you stop trying to serve the entire world from one location. You build a firewalled supply chain inside China to serve the massive Chinese domestic market. Then you build a second completely separate supply chain for your Western markets to insulate it from all that geopolitical and regulatory risk.
And this leads to some really clear board-level directives. First, you have to acknowledge the efficiency penalty as a permanent cost of doing business. Second, you proactively invest in private infrastructure, like microgrids in Mexico. And most importantly, you have to shift the primary success metric your teams are being judged on.
And this is the key takeaway. For the last 30 years, supply chains were optimized for one thing, and one thing only: the lowest possible landed cost. In today's era, the winning strategy is optimizing for the lowest acceptable level of landed risk. It's a fundamental change in mindset from pure efficiency to managed resilience. So we'll leave you with this question. The landscape has fundamentally fractured. A strategy that delivered record profits a decade ago could now be a critical vulnerability. The imperative is to assess whether your operations are structured for the world that exists today, not the one we've all left behind.